What if I told you that without one single industry, the United States economy would have grown by just 0.1% in early 2025? Not a recession, not a crisis, just nothing. Zero. A flat line. That industry? Artificial intelligence, and specifically the spending on AI infrastructure. Now here's where it gets interesting. Because that same fact, that AI is literally propping up American GDP growth, is either the most exciting investment story of our lifetimes or the most alarming warning sign we've seen since March of 2000. Welcome back. Today, we're going deep on the question that is splitting Wall Street, Silicon Valley, and every serious economist right now. Is artificial intelligence the new electricity, a transformational infrastructure that rewires the global economy? Or is it the greatest bubble in financial history, about to wipe out trillions of dollars in wealth? Let's get into it. To understand why the bulls are so confident, you have to go back to 1999. Picture it. Pet.com raises $82 million, spends $1.2 million on a Super Bowl ad, and goes bankrupt 9 months later. Webvan burns through $375 million trying to deliver groceries before there's even a smartphone to order them on. Investor money is flying into companies with no revenues, no customers, and no viable product. The whole thing is funded on vibes and magazine covers. Now, look at today. The companies pouring money into AI are not venture-backed startups burning borrowed cash. They are Microsoft, Google, Meta, Amazon. These are businesses generating hundreds of billions in annual revenue and profit, real profit, cash reserves that would make most countries jealous. In 2025 alone, just those 4 companies committed over $300 billion in AI capital expenditure. That is not reckless speculation. That is calculated infrastructure investment from the most disciplined financial operators in corporate history. AI-related spending accounts for roughly 40% of America's real GDP growth in 2025. Let that land. And here is what separates this from the dot-com era in a fundamental way. In 1999, the internet required the entire physical infrastructure of the modern world to be built from scratch. Fiber optic cables had to be laid under oceans. Servers had to be invented. Broadband had to reach homes. It took a full decade after the crash before Amazon and Google and Facebook became the dominant forces we know today. AI is not starting from zero. It is being built on top of a mature, battle-tested foundation. The GPU farms are real. The data centers exist. The cloud computing networks, AWS, Azure, Google Cloud, are already running at global scale. When Microsoft deploys AI into Excel, it is not building new roads. It is adding a fast lane to a highway that is already there. The usefulness argument. Here's another thing the bulls will point to. AI is already useful, right now, today. Developers using GitHub Copilot write code up to 55% faster in controlled studies. Radiologists using AI diagnostic tools catch early-stage cancers at higher rates. Customer service operations that used to require 200 agents are running on 40, with faster resolution times. Legal firms are doing first-pass document review in minutes instead of weeks. This is not theoretical future value. This is measurable productivity happening in the real economy today. The infrastructure bulls argue that we are in the 1994 moment of the internet, the early stage when adoption is limited, but the trajectory is undeniable. And if you missed the internet, are you really going to miss this? All right, now I'm going to tell you why some of the smartest people in finance think everything I just said is a beautifully constructed illusion. The NVIDIA metaphor. Use this. You've heard of the gold rush, right? 1849, California, tens of thousands of people flooding the Sierra Nevada looking for gold. Some struck it rich, most went broke. But you know who made money no matter what? The guys selling the shovels. NVIDIA is the shovel seller of the AI gold rush. They make the GPUs that every AI company desperately needs. Their stock is up over 800% in 3 years. Their margins are extraordinary. They are printing money. And unlike the gold rushers, they get paid whether or not anyone actually finds gold. This is important context because NVIDIA's extraordinary success does not mean AI is working. It means everyone believes AI is working and is paying through the nose for the equipment to try. Now, let's talk about something that does not get enough attention in mainstream financial media. It's called round tripping, and once you see it, you cannot unsee it. Here is how it works. Microsoft invests billions of dollars into OpenAI. OpenAI then spends a large portion of that money renting computing power from Microsoft's Azure cloud. Microsoft books that as revenue. OpenAI books it as expenses. Microsoft's AI revenue goes up. OpenAI looks like a growing enterprise. Analysts celebrate. Stock prices rise. But wait, where did the money actually go? It went in a circle. Microsoft to OpenAI, OpenAI back to Microsoft. The same dollars, recycled to manufacture the appearance of a functioning AI economy. And it's not just Microsoft and OpenAI. Oracle has landed massive AI infrastructure contracts and simultaneously received billions in investment from the same companies it's contracting with. Google's cloud revenue is surging, partly because Google itself is funding AI startups that then use Google Cloud. The money moves in elegant, profitable-looking loops. Here's a number I want you to sit with. Every single time you type a message into ChatGPT, every single prompt, OpenAI loses money. The electricity required to run those GPU clusters, the cooling systems for data centers, the engineers maintaining the infrastructure. When you add it all up, the compute cost of generating a response is currently higher than what OpenAI collects in subscription and API revenue. The company is operationally unprofitable on every interaction. Now, the bulls will say, scale fixes this. As usage grows, costs per query fall. This is the classic tech playbook. But we are years into mass deployment of these models, and the unit economics have not yet turned positive for most providers. They are betting on a future efficiency that has not arrived. But perhaps the most damning data point in the bear case is this. In a comprehensive study of companies that have deployed generative AI, 95% reported zero measurable improvement in productivity. 95%. That is not a rounding error. That is a near universal failure to deliver on the central promise of the technology. Now, what are the majority of real-world AI use cases right now? AI girlfriend apps, meme generators, AI voice cloners for TikTok, AI art tools for social media content, chatbots that hallucinate legal citations. The gap between what AI is being marketed as, AGI, superintelligence, the end of knowledge work, and what it is actually being used for, social media slop and novelty apps, is enormous, and that gap is where bubbles live. The efficiency paradox. There's one more uncomfortable truth the bears point to. If AI is genuinely making workers more productive, where is it showing up in the data? Productivity growth in the United States has remained stubbornly flat or modest, even as AI spending has exploded. The productivity boom that AI was supposed to trigger, the one that would justify all of this spending, has not materialized in the aggregate economic data. Not yet. And the bears argue that not yet has been the story for 5 years running. Let's zoom out to the macro picture, because this is where the story gets genuinely alarming, regardless of which side you're on. 30 companies now make up 44% of the entire S&P 500. Think about what that means. The retirement savings of 100 million Americans are index-linked to a market where nearly half the value is concentrated in 3 dozen companies, almost all of which are tied directly to AI valuations. Apple, Microsoft, Nvidia, Google, Meta, Amazon. These are not just tech companies anymore. They are the market, and their valuations are priced for an AI future that, as we just established, has not yet been proven. Stat to hit. Without AI capex, the U.S. economy would have shown 0.1% growth in early 2025. The question is whether that spending is building real value or borrowing from the future. The bubble recession loop. Now, here is where macroeconomics gets very dark very quickly, because there's a question that central bankers and treasury economists are quietly wrestling with. Does a potential AI bubble cause a recession, or does a recession pop the bubble? In a classic recession cycle, corporate revenues fall, companies cut discretionary spending, and capital expenditure gets slashed. The first things to go are the expensive, speculative, long-horizon bets. AI infrastructure spending at hundreds of billions a year is exactly the kind of spending that disappears when times get tight. But here's the brutal feedback loop. If that spending disappears, so does the GDP growth it was generating, which deepens the recession, which causes more spending cuts, which hits AI company revenues, which triggers layoffs, which reduces consumer spending. You see where this goes. The talent bubble. There's also a talent dimension that doesn't get discussed enough. The average salary for an AI engineer at a top tech company in 2025 is between $400,000 and $1.2 million annually in total compensation. These are extraordinary numbers, sustained by extraordinary valuations. If those valuations correct, if Nvidia's multiple compresses, if Microsoft's AI revenue is revealed as partially circular, if OpenAI's losses become public in a way that rattles the market, the funding for those compensation packages evaporates. The talent disperses. The institutional knowledge scatters. Rebuilding takes years. This is not hypothetical. This is exactly what happened to the best engineering talent in the world between 2001 and 2003. It took the internet sector nearly a decade to reconstitute. All right, you've heard the bull case, you've heard the bear case. You understand the economic stakes. Now what? Let me be honest with you about something. I cannot tell you whether AI is a bubble or infrastructure. Nobody can. Not with certainty. Not today. The honest answer is that it is probably both, depending on which part of the ecosystem you're looking at and on what time frame. The question for the everyday investor is not, is AI a bubble? The question is, are you a participant or a spectator? Participants own the upside. They hold diversified positions in the infrastructure layer, the companies selling the shovels and building the roads. They understand that even if the gold rush ends badly for most, the shovel sellers tend to survive. They dollar-cost average. They do not bet their retirement on a single AI startup. Spectators sit on cash while the market runs and panic buy at the top. They read the bubble articles and sell everything when the narrative turns negative. They consistently time the market poorly because they are reacting to narrative rather than managing risk. The uncomfortable middle is that being right about a bubble and making money are two different things. John Paulson was right about the housing bubble in 2005. He was also nearly wiped out by 2006 before finally getting paid in 2007. Being early and being right look identical to being wrong until the very moment they don't. The dot-com investors who held Amazon through the 90% drawdown from 2000 to 2001, if they held and didn't panic, they were up over 100,000% by 2020. The investors who sold at the peak in 2000 were spared the crash, but missed the entire run. The math of compounding rewards patience and punishes perfect timing. And I want to close on this, because regardless of what happens with AI valuations,
Regardless of whether this is infrastructure or illusion, there is one asset in this entire equation that no model, no algorithm, no language transformer can replicate: your ability to think critically, to analyze, to synthesize information and make judgment calls under uncertainty. The skills that help you understand what we've discussed today: the financial literacy, the ability to hold two competing hypotheses simultaneously, the discipline to separate narrative from data, those are not going to be automated. The people who will benefit most from AI, regardless of whether it is a bubble or infrastructure, are the people who understand it deeply enough to use it intelligently, not the ones who defer to it blindly, not the ones who dismiss it entirely. The ones who can leverage it as a tool while maintaining the judgment to know when it's wrong. That is the skill acquisition that matters. And that is the investment in yourself that AI cannot touch. On camera, close. If you found this valuable, there are two things I want you to do. First, share this with one person who is trying to figure out what to do about AI in their portfolio. Because the conversation we need to be having is not, is AI cool? It is, what are the actual financial mechanics at work here? Second, drop a comment below with this: are you a bull, a bear, or sitting on the fence? I read everything, and the debate in the comments on this one is going to be interesting. As always, stay sharp. See you next week.